behavioral economics explores why we make irrational money decisions. Traditional economics assumes humans always act logically with their finances, but reality tells a different story. Psychology plays a massive role in how we handle money, often leading us to make choices that go against our best interests. Throughout this video, you'll discover the hidden biases and mental shortcuts that influence your financial decisions every single day, and learn how understanding these patterns can help you make better choices with your money. Traditional economics operates on a simple assumption. Humans are rational actors who always maximize their utility. This means classical economists believe people carefully weigh all options and consistently make the best financial decisions. However, behavioral economics reveals a more accurate picture. In reality, humans are emotional, biased, and predictably irrational when it comes to money. Our decisions are influenced by feelings, social pressures, and mental shortcuts that often lead us astray. Understanding this fundamental difference helps explain why we frequently make financial choices that don't align with our long-term goals. Loss aversion is one of the most powerful forces in behavioral economics. Research shows that losses hurt psychologically twice as much as equivalent gains feel good. For example, losing $50 causes significantly more emotional pain than the pleasure of finding $50. This asymmetry profoundly affects investment behavior. People hold on to losing investments far too long, hoping to break even and avoid realizing a loss. Conversely, they sell winning investments too early to lock in gains and avoid potential future losses. This pattern, known as the disposition effect, causes investors to miss out on substantial long-term returns while letting losses compound. Anchoring bias demonstrates how we rely too heavily on the first piece of information we encounter. Once an initial number is planted in our minds, it becomes an anchor that influences all subsequent judgments. Retailers exploit this brilliantly through pricing strategies. When you see a jacket marked down from $200 to $100, that original price becomes your anchor. The sale price seems like an incredible deal, even though the jacket may only be worth $60. The first number you saw shaped your entire perception of value. This same bias affects salary negotiations, real estate decisions, and virtually every financial choice where numbers are involved. Mental accounting describes how we treat money differently based on its source or intended purpose, even though money is fundamentally fungible. People create separate mental buckets for different types of money. For instance, someone might carefully budget their salary, tracking every expense, while carelessly spending a tax refund or lottery winnings on impulse purchases. This is completely irrational from an economic perspective because a dollar is a dollar regardless of where it came from. Mental accounting also explains why people maintain savings accounts earning minimal interest while simultaneously carrying high-interest credit card debt. The money sits in different mental categories, preventing rational optimization. Herd behavior occurs when we copy the financial decisions of others, assuming they possess superior knowledge or insight. This tendency is deeply rooted in human psychology and served our ancestors well in many situations. However, in financial markets, following the crowd often leads to disaster. When everyone rushes to buy the same hot stock or asset, prices inflate far beyond rational valuations, creating bubbles. Eventually, reality sets in, panic spreads, and everyone rushes to sell simultaneously, causing devastating crashes. The dot-com bubble and housing crisis both exemplify herd behavior on a massive scale. Independent thinking becomes crucial for avoiding these costly mistakes. Confirmation bias is our tendency to search for, interpret, and remember information that confirms our existing beliefs while dismissing contradictory evidence. In financial contexts, this bias becomes particularly dangerous. Once you've invested in a stock or committed to a financial strategy, you unconsciously seek out news articles, expert opinions, and data that support your decision. Meanwhile, you ignore, downplay, or rationalize away warning signs and negative information. This creates an echo chamber where your confidence grows even as your investment deteriorates. Overcoming confirmation bias requires actively seeking out opposing viewpoints and honestly evaluating evidence that challenges your assumptions. Present bias describes our tendency to overvalue immediate rewards while heavily discounting future benefits. Psychologically, our brains struggle to connect with our future selves, making distant consequences feel abstract and unimportant. This explains why people overspend today despite knowing they should save for retirement decades away. The pleasure of buying something now feels concrete and real, while retirement seems impossibly distant. Present bias also drives credit card debt, as the immediate gratification of a purchase outweighs the future pain of interest payments. Combating present bias requires making future consequences more tangible and creating systems that automate beneficial long-term behaviors before temptation strikes. Overconfidence bias leads us to overestimate our abilities, knowledge, and capacity to predict future events. Most people rate themselves as above-average drivers, investors, and decision-makers, which is statistically impossible. In financial markets, overconfidence manifests as excessive trading. Overconfident investors believe they can successfully time the market or pick winning stocks, despite overwhelming evidence that professional fund managers rarely beat index funds over the long term. This leads to frequent buying and selling, which generates trading costs and taxes that erode returns. Research consistently shows that the most active traders typically achieve the worst results, yet overconfidence keeps them convinced they're different. Understanding behavioral biases is the first step, but overcoming them requires deliberate strategies. Awareness means recognizing when emotions or biases might be influencing your decisions, especially during market volatility. Creating systems involves establishing rules and automating behaviors, like automatic retirement contributions, which removes emotion from the equation. Pausing before major financial decisions gives you time to cool down and evaluate choices rationally rather than emotionally. Finally, seeking accountability through financial advisors, trusted friends, or family members provides outside perspectives that can spot biases you're blind to. By implementing these strategies, you can harness the insights of behavioral economics to make smarter financial decisions and protect yourself from your own psychological tendencies.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.